Okay, everyone. If you all knew, I just spent the last 15 minutes doing this and not even pressing broadcast. So I'm going to try this again. Okay, I'm going to try to help everyone out and do the first 10 questions of the SIE practice exam that is provided on the FINRA website. Question numero uno. Which of the following Form U4 reportable events results in a statutory disqualification? Statutory disqualification, as I can't speak, is saying that you cannot register with a FINRA firm. Personal bankruptcy filing, no, doesn't work. That's just you declaring bankruptcy, nobody cares. Might be disclosed at some point, but right now, we don't care. It's not going to kick you out of the firm. Okay. A written customer complaint alleging misappropriations of assets. It's just alleging. It's not actually you're in trouble. So yes, that is not going to be reportable. Okay, that works. Now, the next one, a felony theft charge. Don't care. It's a charge. I do care. If my employee was charged with a felony, I would care. But he is innocent until proven guilty. So that's not statutory disqualification. To save myself embarrassment, I'm going to say SD. Now, a felony conviction, bing, 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 a felony conviction for driving under the influence is it, because you're convicted of a felony. We don't care. If you're convicted with a felony in the last 10 years, you're out. It's your SD for 10 years. Which of the following actions violates FINRA rules regarding selling away? Okay. So selling away is when you do transactions off the books and records of the broker-dealer. That means you're doing it without their permission. Okay, so now, recommending to a customer the services of another broker-dealer. No, that just means you're a horrible employee. Sharing commissions with another registered representative in the same BD, totally okay. I'm totally fine with that. As long as they're fully registered in the same states and all that, you can share commissions. You just got to tell the client. Advising customers to buy mutual funds that amounts just below a discount level. Well, break points are discount levels, meaning that if you invest in a mutual fund and you invest a certain amount of money, if you cross a break point, the sales charge is reduced. It starts at 8.5 max. We know that. It may be, I'm just saying, maybe at 10 grand, maybe it drops down to 7%. Maybe at 30 grand, it drops to 6. But a representative telling customer to buy just below the break point gives that registered rep a bigger commission so he can make a payment on his Maserati. That's not good. That's called breakpoint selling. D, engaging in private securities transactions without written prior consent of the employing BD. That's the answer. Engaging in private securities transactions, that means you're doing securities transaction, acting as a rep away from your broker-dealer without their permission. Okay, so I'm going to go with D. D as in dandy. A registered rep who wants to place a mutual fund advertisement must obtain written approval from which of the following parties? Okay, so here's my rule, and this will help you on the test. No regulator ever approves anything ever. No regulator ever approves anything ever. Ever. So let's go with that. FINRA, regulator, out. Each state securities administrator, that's the regulator for the states, which is the 63 or the 65 or the 66 you guys are taking later. That's out. The investment management of the SEC, out, because it's a regulator. So really the only people that approve are principals of the firm. So we're going to go with C on number 3. Now, just be warned, if you take it, it won't be in the same order, but I'm trying to help. The last transaction in XYZ 5.5% 2030 was at 102. So let's read this. XYZ is the issuer of a bond. 5.5S means 5.5%. So that's the coupon. 2030 is the maturity date. Okay? That's the maturity date, 2030. And it's trading at 102, which means 102% of par, which is 1,020, which means it's above 1,000. So above 1,000 is a premium. 1,000 is par. Below 1,000 is discount. So what is this, folks? It is over 1,000. So it's 102. It's a premium. Let's move on. Company ABC announces a 20% stock dividend. So whenever you hear dividend and you see a percentage, you almost always have to think it's a stock dividend. unless you see the word preferred near it. Stock dividends means you're getting more shares, but they obviously have to drop the price. So there's a 20% stock dividend for its common shareholders. If the customer owns 1,000 shares at 50 bucks, what's the new price and number of shares? Okay, so he has 1,000, we're adding 20%, which is 200 of 1,000. So he now has 1,200 shares. So now we're down to either C or D. But it's a zero-sum game. So we know that the number, so 1,000 times 50 is 50,000. The new number still has to be 50,000. So you can do 50,000 divided by 1,200, and boom, you're going to get 4167. It does not change. So I'm going to go with C, 1,200 shares at 4167. Number 6, the owner of which of the following products is most exposed to inflation risk? So inflationary risk is mostly for fixed income long term. Inflation, prices go up. Another word for that is purchasing power risk. So prices in the world go up. So your money that you're getting might be worth less. So I look at this and I go, okay, utility stocks is a common stock. They grow, usually beat inflation. Out. Common stock is out. So let's throw out the blue chips also, because blue chips and industrial, I'm stuttering, whatever. Utility stocks and blue chips are both common stock. They beat inflation. Boom, they throw them out. Treasury bills, they're short term. What are they? 1, 3, and 6 months long. And they have basically no risk. They are actually the risk-free rate of return. So treasury bills are risk-free rate of return. Not, well, that's a risk, and they're free of it, so it's not that one. And they're too short term anyway. So treasury bonds, they pay the same amount of money every 6 months, every year. So what happens is as prices go up, that 6 months goes lower and is worth less and less. So letter C is inflation. Okay. Which of the following investment risks is the greatest risk in variable life insurance? So boom, I hear the word variable. Whether it's an annuity or life insurance, I don't care. Variable means that they invest in the market, and I'm investing in the market. So if I invest in the market, guess what? I have market risk. So let's go down the list. Credit risk is for bonds. Credit risk is for fixed income. We don't have that. This is not fixed income. Jump down to inflation. Inflation, again, is for fixed income. Now, a fixed life insurance or a fixed annuity would have inflation risk because they pay the same amount of money every time period. Interest rate risk, again, is for bonds. Because if you get an interest rate and rates go up, the prices of your bonds go down. That's not the case here. It's a variable, which means it's invested in the market, so we have market risk. And we should beat inflation. That's kind of the deal. Under the Securities Act of 1933, registration is required for which of the following securities? So first of all, you register shares that are issued in the U.S. That's the way it goes, okay? So now, look at Eurodollar bonds. That's like Apple issuing a bond in the United Kingdom, but denominated in U.S. dollars. That's a Eurodollar bond. It's issued outside the country, no SEC, no registration. Muni bonds, it's a government. It's a state or city government. They're exempt from federal law. Boom, don't have to do that. Look at D, securities issued by the federal government. Federal government, exempt from federal law, doesn't register. Now, even though they're exempt from federal law from registration, they are not exempt from anti-fraud or anti-money laundering. Nothing is exempt from anti-money laundering or anti-fraud. So the answer here is an ADR. An ADR is when like a bank, like a Deutsche Bank or a Goldman or a Bank of America, goes over to London, buys a bunch of like British Petroleum, packages it, and then sells that package of shares in the U.S. Since it's being sold in the U.S., it has to register with the SEC. So the answer here is number C. Number C, letter C. Okay. Roth 401k, Roth individual retirement account, plan share which of the following? Contributions are made pre-tax. Neither account has maximum contribution. Neither account is subject to early distribution. Qualified distributions are excluded from the federal income tax. So Roth means it goes in after tax, and then if you hold it the right way until it's qualified, it comes out tax-free. You don't pay taxes. The greatest thing invented ever in the history of Wall Street, other than me. So again, contributions are pre-tax? No, because they're put in after tax. It's a non-qualified plan after tax. Neither account has maximum contributions. No, they both. Any retirement account other than non-qualified annuities has a contribution limit. Neither account is subject to early distribution penalties. Nope, they are. It's a retirement account. You can't take it out before 59 and a half unless you have a really good reason. You're dead, disability, education, first-time home buyer, stuff like that. Qualified distributions, which means you've met the rules, either you're 59 and a half or one of the other things. If you pull it out, you do not pay federal income tax. That's why Roths are awesome. You don't pay federal income tax. So I'm going to go with D. Which of the following represents the effect of a stock split? Now remember, a stock split is a zero-sum game. Again, if you own one share at 50, you now own, if it's a 2-for-1, you now own 2 shares at 25. It's still going to be worth $50. So it's like a big pizza. You have a big pizza, you cut it in half, it's still one big pizza, but each slice is smaller, but add them together, it's still the same amount. So the price per share of common stock increases? No, because when they do a stock split, a forward stock split, shares go up, prices go down. A reverse stock split would be shares go down, prices go up. Now, the price per share of common stock decreases. Okay, we know that's the answer because it's already picked by me. So the price per share of common stock decreases because there's more shares, worth less. The ownership does not change. If you own 100 shares at 50, you now own 225, but everyone else has more shares too, so it doesn't change your percentage. So I'm going to go with B, your price per share decreases. Now, I think I've done this. Did I double hit? Okay. Now, if a market maker posts a quote of 10 to 10, 10, 25 by 10, which of the following actions is a market maker willing to take? So he puts a quote up there, and it has to be firm, which means he has to honor it. If somebody comes in, he has to honor it. So the first number is the bid, the second number is the ask. So the first number is the bid, it's where he's willing to buy. The second number is ask, is where he's willing to sell. So let's look. He's willing to buy at 10 and sell at 10, 10. So that's A or B or A or no, it's either B or D. But now we have to find the numbers. Look to the right. 25 by 10. 25 means 25 round lots of 100. So that's 2,500 to buy. And 10 is 10 round lots of 100. So that's 1,000. 10 times 100 is 1,000. So we got to find that. I'm willing to buy 2,500 shares at 10 and sell 1,000 shares at 10, 10. So that would be B as in boy. Okay. This one always confused me because I didn't know what they're asking. Under FINRA rules, non-cash compensation connected with the sale of variable contracts includes all of the following except. So now, except is saying which one is not a non-cash contribution. So if I give you a compensation, so if I give you a gift, that's non-cash, so that's not it. If I give you a meal, that's not cash, so that's not it. If I give you lodging, like a place to stay, that's not cash, so that's not it. Commissions are paid in cash, so that's going to be the answer. All the following are non-cash except, so they're saying which one is cash. Commissions are cash. Okay. And we are going to end with this one. Which of the following comparisons best describes the essential difference between a primary distribution and a secondary distribution? A, primary can only be made for equity issues, while a secondary distribution can be made for both equity and debt. No. A primary distribution can only be made for issues that exceed a specified dollar amount, but secondary is made for all. No. Primary distribution must be made at a fixed public offering price, while secondary is done at the current market price. No. A primary distribution involves the sale of a newly issued shares by the issuer, while a secondary distribution involves the sale of already issued and outstanding shares. That's the answer, but let me talk about this. So primary means the issuer is getting money. So I'm going to issue either for the first time, which is an IPO, or additional times where I'm the company raising money, getting the shares. That is a primary. Primary is where the issuer gets money. A secondary is these are shares that are already out there in trading. So like, say Microsoft. We have Bill Gates, who owns a little bit of Microsoft, and he wants to sell some of his shares, but he would normally have to follow the 144 rules, where he couldn't sell more than 1% of the outstanding or the 4 weeks trading volume. You should read about it. Say he doesn't want to do that, he can actually do it in an offering with a prospectus. A lot of times he'll piggyback, or they will piggyback on the actual company issuing more shares. So primary is when the issuer gets the money and he sells shares, creating new shares. A secondary is like shares owned by a big owner who's selling shares already that are already issued, but it's still through the offering process with the prospectus and all that. So I'm going to go with D. Okay. Last one I know I like. Which of the following actions is required of a broker-dealer's anti-money laundering program? Okay, so the AML program, you have to set one up. And I'm going to just tell you, you have to designate an officer who handles it. So what happens is he can be the fall guy. So which of the following actions is required of a BD's anti-money laundering program? You don't have to identify the regulators responsible for the CTRs. You don't have to, that's not, the anti-money laundering doesn't mean you have to conduct background checks of all employees. Actually, FINRA does that now. Filing of the firm's AML program with FINRA, again, you don't file it with them, you hold it, and then they come and inspect you and tell you how wrong you are, but they won't give you advice. They'll just tell you, no, change it. Designating an AML compliance officer, that's what you have to do. You have to name a compliance officer so he can set up he or she can set up the program. So that's that. Okay. Okay, sorry, I'll stop at 15. It's a round, not even number, but it's an easy. At issuance, so that means at issuance, when it's issued, which of the following debt securities mature in 1 year or less? Other words, which one is like a money market? Okay. So Fannie Mae bonds, Ginnie Mae bonds are both mortgage-backed securities, which means they could be up to 30 years because that's how mortgages, a lot of them work. So out, A and B out. Treasury notes, well, let's see. T-bills are 1, 3, and 6 months. T-notes are 2 to 10 years. T-bonds are up to 30 years, so that doesn't work. So T-notes are 2 to 10, that's out. And I kind of led with the thing. So money market instruments are pretty much debt instruments that are 1 year or less. That's the definition. Okay, so we did 15 questions. I hope that helped. And I am done screen sharing. Okay, guys. That was a quick, I don't know, 15, 20 minutes on this. I hope that helped. I am just trying to pay a little back. Thank you very much, and I will talk to you all later. Bye-bye.